Welcome to session 6. This is actually session 6 because session 5 was divided into 2 sessions. Okay, so in our last 3 sessions, we went deep on equities and fixed income, to the two traditional pillars of investing. Okay, that's about everything that you should know actually to know about investing. But today we are going beyond those to explore alternative asset classes that can add diversification, that can add growth potential, and resilience to your portfolio. That's the goal. We'll cover three major things in the alternative asset class. One, real estate, that's called REITs in the public market. Then commodities, with a focus on, all commodities like gold and wheat and all those things. And cryptocurrency, because people keep asking about cryptocurrency. Private markets is a big deal that we will have a separate session on that. This is still a part of public market. So we're going to cover these categories. So 1, real estate; 2, commodities; 3, cryptocurrency. These aren't replacements for stocks and bonds. Okay. You cannot just invest in these things only. Stocks and bonds are the main thing. Think of them as like powerful additions that can help your portfolio perform better in different market conditions. Okay, whether your family has always talked about, our families have always talked about, investing in property. Most of us are very curious about Bitcoin, and then this session will give you knowledge to make some informed decisions. So again, going back to, we spoke about our thali, right? So the think of your portfolio like a thali. I always say that you wouldn't fill the whole plate with just rice. Okay, so a little dal, a little sabzi, a little roti, and achar alongside makes like the meal complete. So that's exactly what alternatives do next to stocks and bonds. Stocks and bonds, or your curry and dal. I mean, dal and rice. So you need something else with that. So that'll be this. And to make it concrete with numbers, in 2022, because that's the recent where you had such a big drop. So S&P fell about 20%, okay? And bonds dropped roughly about 13% the same year. The first time in decades that both of them actually sank together. It usually does not happen. This was the first time, like in 2022, you saw that both of them like sank together, while gold finished kind of flat. I wouldn't say it went up, but it was flat. A family holding even 10% slice of gold, like slice in gold of your whole portfolio I'm talking about, would have noticeably softened that blow, the double blow that came across. Keep that example in your back pocket because it answers the question everyone is silently asking: why should I even bother looking at something beyond what I already know? When stocks and bonds can give me everything, why should I even know this? There are certain situations, conditions in the market that leads you to think about having this diversification, which acts as a cushion for you. That's the reason why we are doing this. Okay, so why do we have to look beyond? Why should you even look beyond? The simple answer is diversification. Okay, so let me explain what that really means in practice. As I told you, the stock market went down like 20, almost 20 to 25% in 2022. Gold kind of held steady and kept ground. So when inflation was running at 9%, that was what it was. In 2022, the inflation was 9%. Real estate values and rents were rising alongside it. Okay, right alongside it. Everything is kind of connected in the economy. So when you know that, this is happening, when inflation is going up, your portfolio gets affected. How does it get affected? Like this. So when you hold, then different asset classes respond to those economic conditions in a very different way. And owning a mix means you're never fully exposed to one scenario. That's the whole goal. Diversification is whole different things so that, you're not exposed to just one type of scenario. So in our families back home, they've always taught us, like, there's always an instinct to diversify. It just came to them automatically. property, gold, fixed deposit, business, all these things, like we are exposed to that already. That wisdom is exactly what in an MBA, a portfolio theory validates. So research shows that portfolio with even like 10% to 20% in alternatives can reduce your overall volatility. Because every day now, especially now when you see the volatility is really high, the VBIX, we call it VBIX. When we measure the volatility in the market, we call that VBIX. So the VBIX rates are really, really high. That means there is a lot of volatility going on due to different reasons, macroeconomic conditions, due to geopolitical situations, due to changes that are happening in leadership. There are a lot of things the war. So many things are happening. So because of that, you see that there's the stock market is highly volatile. So what happens is when you invest like 10 to 20% in alternatives, it will reduce your volatility by at least 15 to 20% while maintaining the similar return. You still will get the return, but you're able to maintain that. The key insight is correlation. Okay, so you want assets that all don't move in the same direction at the same time. So when market go up, like we need something that stays stable. Like that's the gold I told you. When market went down, it still stays stable. Gold has a way of not correlating with the market. Other things, real estate is the same way. So that's why we look beyond traditional stocks, bonds, alternative. A complete portfolio uses everything for maximum resilience. So, what exactly? First, we'll look at real estate. Real estate has been one of the most reliable wealth builders in history. Okay, so if you're really going into a different, other than stocks and bonds, for us, like for the Indian families, property is the first investment they think of. Even before you could invest in stock market, people have invested in real estate. So that's what they have thought about. The key difference between thinking about real estate back home in India versus here is back home, our cities are still developing. Okay, so there is a lot of potential for the market to run up and rally. Whereas here, it's a developed market. So when you have a developed market, it is not like it's going to increase or give you that kind of returns what you see back in India. Although, like you have, like, say a place like Austin, Texas, or you say a place like new places that have become the new hub for all these big companies to go. There you will see a little kind of this run up, but that run up is not, the duration of those run up is still not as big as what you will see back home. So that's the key difference. Okay, so but buying a real estate property also requires a lot of capital, huge capital. Then after buying, you have to deal with tenants, and then you have to deal with maintenance, and then you deal with illiquidity. So you have all these things going on. So different kind of things. Like, first of all, it takes away all of your money. Second of all, you have to deal with all these tenants, and then all these illiquidity, because you can't just sell when you want to, because you don't know how the market is, and you're in charge of maintenance. So these are the things. That's where REIT comes into you. So the REIT is nothing but real estate investment trust. It's called real estate investment trust. A REIT is a company that owns, it behaves like a company that owns, operates, finances income producing real estate. So if you want to happily get into real estate as a diversification factor, REIT is the best way to get into it. Okay, so by law, this is like not, no, it is not everybody. The REIT has to distribute 90% of their taxable income as dividends. That means you will get your dividends because it's a trust, a real estate investment trust. So all the REITs must send you, like, distribute at least 90% of their taxable income as dividends, which is why they tend to have better yields. They give you like at least, they sometimes you'll hear about REITs giving you 5 to 6% easily because of that, because they have to give that back to you. You can buy shares of a REIT just like buying a stock. So it is like available, and you can buy like a stock, you can sell like a stock, and it's a marketplace where you can buy and sell. So through your brokerage account, wherever you're buying stock, bonds, and all that, you can buy REIT too. So in 2025, REITs delivered strong fundamentals. Okay, so they had 6.2% is what they gave, and it rose like the net assets that they had rose like 4.7%, and dividends they gave was about 6.3% year after year. So looking into 2026, sectors like data centers, you all know, many of you working in IT and hearing about all this AI and all the things that is going on, that sectors like data centers is driven by the AI demand. So because there is so much of demand, we have data centers coming up everywhere. We have senior housing coming everywhere because the aging population is really, really high. That's a macroeconomic indicator that there will be a lot of senior housing. And then you will have a lot of industrial warehouses, which means like e-commerce, like your most of the things now you buy online, don't go to a shop to buy, so they don't hold inventory. So you need to have these industrial warehouses where Amazon and eBay and all these guys, have their goods or inventory. So e-commerce are showing particularly really strong growth. So having said that, the easiest way is to get started and invest in a REIT. Okay, there are ETFs, just like stocks and just like bonds. These are available in the market. So you just go, you can buy. What happens is, if you buy one ETF of REIT, it'll have like 150 companies that holds all the real estate investment trusts. So that way you are diversified and you are exposed to all the whatever I spoke about, the sectors like data centers, the sectors like senior housing, the sectors like industrial warehouses. You will be exposed to all those things. So you automatically have a diversification. So and if you go through an ETF, it's like, that's the best way to do because the cost is also low. Okay, so that is real estate and REITs for you. And how does that work? Okay, let me break down how actually REITs work, because the mechanics are really elegant, I will tell you. So a REIT is a company that pools investor money to buy and manage income producing properties. That's what it does. REIT is nothing but it pools the money and it manages income producing properties. Think of it like a mutual fund. We spoke about mutual fund, right? But instead of stocks, mutual fund will hold so many stocks, and then a manager will manage that and give it to you. That way, this is the same thing. Think of it like a mutual fund, but instead of stocks, it holds real estate. Okay, there are different types. You have equity REITs, which means like, they own physical property and earn rental income. That's what the equity REITs do. And there are mortgage REITs, which means they invest in real estate debt. They don't invest in equity side of it, but they invest in debt and earn interest income for you. So they are lending the money for real estate. They made all the whole group, like, whoever want money to be lent to manage properties, they lend the money, and that's how they get the interest and they pass it on to you. And equity real estates are different. They own all the physical properties. They get interest, the rental income. Then they will get all the lease income that they give it to all the software companies and all those things. So most individual investors, if you really wanted to, have a diversification and also make some money, equity REITs are the best one to go with. The dividend mechanism is key. Okay, I told you, by law, REITs must pay out at least 90% of taxable income as dividends. Whatever income they make, 90% of that they have to give it out as dividends. This means you get consistent cash flow. Okay, it's similar to bonds, but with the upside potential of property appreciation. See, these data centers, I don't know if senior housing will have property appreciation, may not be, but the data centers will have appreciation because there's so much of demand for that right now. So at least in the next 4 or 5 years, there will be a lot of demand for data centers. So this means that you're going to get consistent cash flow, similar to bonds, with upside potential of appreciation, property appreciation. In 2026, the Fed is expected to continue reducing the interest rates. We spoke about it last week in our session, right? Reduce their that what will happen to that when they reduce the interest rate, because lower rates, then the borrowing cost comes, it becomes lower. So which is a great news for REITs, right? Because they lower rates, reduce their borrowing cost, and make their dividend yields more attractive, so that they can pay you more when they compare to bonds and savings account. So they can actually, they themselves compare themselves with savings account and bonds and all this, and because of the safety feature, they have to pay you that. That is why they sit on that same mechanism where you can compare them with that. So and REITs valuations are currently at historically very, very attractive levels because of the demand that we have. The REITs is like trading at significant discounts. We spoke last week when we spoke about bonds, we spoke about how the pricing matters, how when it is sold in discount versus when it is sold in premium, according to the movement of the interest rates. So everybody who heard that, they know what I'm talking about. So now what is happening is, because the interest rates are going to go down, it is trading at significant discounts to their net asset values. That means the value that you will buy it in the market, similar to what we saw. This is like a good comparison for you. Similar to what we saw in 2008 financial crisis. During the 2008 financial crisis, this was the rate we had for REITs. That's the same thing. Are we in trouble? No, we are not in trouble, because that was like 4-5 times. It was the mortgage, subprime. Each one was giving to another, and it was all combined in one. Now it's a real demand in the market, because the data centers are for real. The storage places for iCloud and all those kind of cloud spaces for real. So these things are happening with a real demand in the market. So it is not the same, but the levels are at the same where you can pick up these REITs. So for most of you starting out, you should start with an ETF. That's the best way to go about, because that's the way you learn what is inside of it. How does that act when you see it go up and down? You understand what is it correlated to, and also you understand what are the factors, other economic factors in the market, that is actually making them go up and down. So start there. As I told you, that's the simplest approach. So you will get exposure to a lot of properties across sectors for about, say, $80 or $90 per share, because those ETFs only range in those that is the range of the ETFs right now. Okay, so that is the REITs for you. The next is commodities. Okay, commodities are the physical building blocks of the global economy. Okay, they are tangible, the real world assets that everyone depends upon. Okay, so when you invest in commodities, you are investing in things people actually use every day, right? Commodities are things that we use every day. The oil that powers your car, the copper in your phone that you use, the wheat in your roti. So all these things are commodities. For Indian families, this concept is very, very intuitive. For us moms, it's very, very intuitive. Your parents, grandparents understand the value of these physical assets. The key reason commodities belong in your portfolio is inflation protection. So when there is high inflation, it really helps you. When prices rise across the economy, commodity prices typically rise too. Okay, because commodities are the things getting more expensive. When inflation is more, what happens? When we go and buy our daily roti and gas and everything, it's expensive. So you're paying more. So it grows. So that's the concept here. So commodities are the things that gets expensive when inflation is high. During the 22-23, I told you the inflation was really, really high. Commodity prices surged. When stocks fell, bonds fell, gold remained flat. We just spoke about gold. Gold was flat in 22-23, whereas commodities just, it just went up. So it actually rallied. It's not just went up, but it went really high in comparison to stocks and bonds. That is the diversification benefit in action for you. So in 2026, that is today, the commodity landscape is very, very interesting. It's different. Gold has been on a historic run. Okay. So driven by central bank buying, and there's also geopolitical uncertainty because of the war and because of so many things happening. They are buying the gold. So copper is benefiting from AI driven, data center construction. We need a lot of copper there. So copper is also going up. Copper is benefiting from AI and the green energy transition. You must be hearing about all the green energy that's going on. US will get back on track maybe sometime in the future, but at least it's happening all around the world. You do not need to buy physical barrels of oil or bushels of wheat. You don't have to do that. Commodity ETFs are available. It makes it easy for you. You can, sorry, Madhvi, you said something? Okay.
No, continue,
So
Padma.
okay, so the ETFs make it easy. The commodity ETFs make it easy for you. Look at commodity ETFs. There are commodity ETFs for gold. There are commodity ETFs for oil. There are commodity ETFs for other things also. So if you want to have a 5 to 10% allocation to commodities, it can meaningfully reduce your portfolio's volatility. When I say this, it includes gold, it includes this, and it includes about whatever we are going to talk next. So the whole commodity bucket should not be more than 5 to 10%, because this is something that is highly volatile. So but it also helps you when stocks and bonds fall. So that way it can meaningfully reduce your volatility, but it's a good diversification to have. Okay, that's commodities for you. Sorry. So okay, next is the gold. I think this is what commodities. Yeah. Next is the gold. Okay, gold, we all know about gold. I don't have to explain at all. This is one of the most important alternative assets, because if you really ask me, this one requires its own deep dive. But I don't want to do that. I just want to touch upon it and say that it also holds a very special cultural significance in our community. We all know that. And we all have understood the value of gold for generations, right? Because our wedding jewelry is gold. Our Diwali gold, we buy coins for Diwali, gold coins for Diwali, savings that hold their value. We think, and we have always done that. The difference now is how you invest in it. It doesn't have to be a physical gold, but how you invest in that gold market. So gold hit an all-time high. Everybody know here because we all follow gold, right? It was about 5,589 per ounce in January 2026. It ran a lot during the last year. It was a massive 55% rally in 2025. So if anybody were holding to gold, like any of the ETFs or gold funds, then you definitely saw a 50% rise in those investments. While it has corrected now this year, in the last 3 to 4 months, it corrected about 16%. So it went down about 16%. Since then, I think it's somewhere around 4,600 to 700 now. So the structural drivers still remain really, really strong. Central banks, particularly in China, India, and emerging markets, have been buying gold aggressively. So they buy about 1,231 tons in only the first quarter. They bought 1,231 tons, just the emerging markets, China, India, and other emerging markets, and which is worth about $193 billion. So if you looked at the news, JP Morgan forecast that gold could reach about $5,000 by year end of 2026. So they are saying from 4,700, it may still go up again to 5,000, but it will not touch the 5,600 what it was last year. So why does gold do well? That's the question that we need to think, pause, and reflect. Okay, there are three reasons why gold does well. It's a hedge. against inflation and currency devaluation, both. So it's a good hedge. It performs well during geopolitical uncertainty, and it has zero correlation with stocks over a long period of time. If you really look at the gold performance in the last so many years, it has its own track. It does not follow anything. It does not follow the stock market, or it doesn't follow all these things. So it's a great hedge against inflation and currency devaluation. Okay. When the stock market dropped 25% in 2022, gold was essentially flat. So I told you that. So that's how gold is. For investing, I told you have options. You can look at physical gold, where you have coins and bars from dealers, or we know where to go and get our gold coins and gold. Then you have investment ETFs, where you can invest through them, which track the gold price, which track the gold mining stock, and then you can which will offer you a good leveraged exposure to that. For most people, a gold ETF is simple and most liquid option. So the three reasons for which you will do is it's a hedge against inflation, it is a currency devaluator, and it does not follow the stock market. It follows its own track, and it is not, there is no correlation at all. So it's the simplest, most liquid option. So as I told you, the whole commodity bucket can be about 5 to 10%. You can decide how much you want in gold, how much you want in commodity, and how much you want in rest of the things. So cryptocurrency, okay, the digital, everybody. Now let us talk about the most controversial and exciting alternative asset class, right? Everyone keeps asking about this cryptocurrency. Personally, I do not advise on buying cryptocurrencies and things like that, but it is good to know what is out there. Okay, so I'm not recommending or anything, but it's good to know what it is. I know this topic specifically generates very strong opinions. So some people think crypto is the future of money. Okay, others think it is speculative bubble. So the truth is somewhere in the middle. Okay. And as informed investors, I want you all to be informed investors, which is the whole goal of all these things. We need to understand it regardless of where we personally stand. So cryptocurrency is a digital money that uses blockchain technology, a decentralized, transparent ledger that records every transaction. Unlike dollars or rupees, no government or central bank is controlling this cryptocurrency. No one controls it. Bitcoin was created in 2009 and remains the dominant cryptocurrency with about 50% market share. Okay. Ethereum is second at 10 to 12%, and it serves as a platform for decentralized applications and smart contracts. So that is that the total crypto market sits at around I would say around $2 trillion as of now, as of 2026, down about 18% from 2025 cycle peak. It was really at its peak last year. Now it fell about 18%. And then in first quarter of 2026, Bitcoin dropped about 22% to below 64,000. And the Ethereum fell about 35% to $1,800. So a reminder for you to just see how volatile this class is. It's extremely volatile. This thing frontier. This one is it tends to be extremely volatile. It has never been like, even though it peaks and goes down and peaks and goes down, it's always volatile. So, but the institutional adoption story is real. Okay, so because we see it, we hear about it. Spot Bitcoin ETFs have already come in the market where we can use it instead of going and dealing with these Bitcoins. You can buy Bitcoin ETFs, and it's available already. So spot Bitcoin ETFs in the US have somewhere in the region of 128 billion in assets. So about I would say 350 entities, including governments and public companies, now hold Bitcoin on their balance sheets. totaling about, I would say, 350 billion dollars. So the Europe Union's framework is being fully enforced by mid 2026, creating clearer rules because they have 27 countries. They have made a segue into this faster than what we have done. So if you decide to invest, there is a practical framework available for you. So if you decide to invest, like, start with Bitcoin and then use blue chips that together make up most of the market. So use regulated platforms because you cannot buy real time Bitcoins other than ETFs and things on the market. But if you want real, then you go to Coinbase, or you go to some of the crypto that some of the companies offer, some of the platforms. I have not ventured into that because I just feel there's a lot of regulation that's required in that particular segment. So that is the easiest way if you want to have a little exposure. As I told you, 5 to 10, it should not be more than 1 to 5% of your total portfolio. If it is 1 to 5%, that means you can afford to lose it. It's okay for you. Then there are ETFs that are available that you can invest, and without dealing with private keys and wallets and all those things, you can just go and invest in these ETFs. So you benefit from the upside without devastating your finances if crypto falls like 30%, 50%, which always does. So finally, I would always tell you dollar cost average it, because you invest a fixed amount regularly, maybe $100, so that you're just seeing how this market is working and understanding the mechanism of that, and you're still not being left behind. So to smooth out this volatility, that's the best way to do it. So when you do dollar cost averaging, even if it is like 40% up, 50% up, you're capturing that as well. If it is 20% down, 10% down, you're capturing that as well, because at different times you're entering and you capture those bases. So treat crypto like a hot sauce, okay? A little in your thali adds a flavor. Too much will ruin your meal. So it's like very little. So if you really want to understand, learn about it, and you can afford to not mind that going up and down so much, yeah, that is there. So in Europe, as I told you, they are better regulated. It's called MICA. Okay, MICA regulatory framework is Europe's thing. We are not yet there because regulations in a capitalist country is a little, we take a little time. So MICA stands for Markets in Crypto Assets Regulation. Okay, the EU's first comprehensive block-wide framework for crypto assets, not already covered by the financial law. So the financial law has nothing to do with it. Bank has nothing to do with it. Government has nothing to do with it. It's an independent unit called MICA, which does all these things. So it replaces the old patchwork of national rules with a single rule book across all its 27 members. And key points are that, scope, it covers issuers and service providers dealing in crypto, and including stable coins like utility tokens, exchanges, custodians, and all those kind of things, but excludes asset already treated as financial instruments. So you will this MICA will not have any ETFs and things like that. Okay, so that is the one. Second thing is stable coins. It creates two categories: asset referenced tokens and e-money tokens with strict reserve governance. Okay, that is what it does. We do not have all this in the US, but if you are in Europe and you're hearing about MICA and all these things through some of your friends in Europe, that is why I just wanted to give you a briefing as to what's going on in this particular market. And then third is service providers. Crypto asset service providers must be licensed in EU member state, and then they can then passport their services as a whole block. So the goals for them is consumer and investor protection, which is really high in Europe, and financial stability, and they want to have a legal clarity to support responsible innovation on this. So that is why I just wanted to leave you with these things. But in the US, we do not have a big regulation around that. Okay, so I just wanted to talk to you about currency as well. Currency is one of the thing, I wouldn't say it's one of the commodity. It's a separate market by itself, but it's important for us because it's exposure that almost no one in our community talks about. Okay. But I know it touches every family that keeps money on both sides of the world. If you send funds between India and the US, or you expect an inheritance from India, you're carrying currency risk. That's important. You should know that whether you realize it or not, you're carrying the risk. So here's the simple version. The rupee has weakened like from roughly, I would say, 40 per dollar 20 years ago. That was it when I came. You all must, somebody must have come 30 years ago, 40 years ago, all those things. But it has to round today, it's about 94. So that's about how much value lost. You can do the math, right? It's a lot of value lost against the dollar every year on an average. Any money held in India is denominated in rupees. So even if it grows in rupee terms, its value in dollar can shrink as the rupee falls. So an investment that earns probably say 12% in India, which is now rare because now is maybe lesser. 12% in India can probably roughly be about 7% once you convert back to dollars. Okay. After a typical year of rupee depreciation. This matters most for two things our families deeply, deeply care about. Okay, savings parked in Indian accounts and inheritance or property which is left in India. It means you should be intentional about the balance. You cannot think that when I left behind and came, it was so much, and today I have lost so much. No, it's just that the currency depreciation matters a lot. Rupee assets carry currency risk, dollar assets give you stability. So it's important for you to know holding a thoughtful mix of both keeps the exchange rate from quietly eroding the wealth you worked hard to build. That is the whole idea of currency. I just wanted to bring that to you. It is nothing that you can invest or in, you're always doing that already. So I'm not saying that it has to be part of the portfolio, nothing like that, because we all know every one of us here are exposed to currency risk. So that is what currency is all about. And this is your alternative assets playbook. Let us bring it all together. So we covered, I want you to walk away with clear, actionable takeaways. First, alternatives are about diversification. It's not speculation. The goal is not to get rich quick. It is to build a more resilient portfolio that can weather different economic conditions. A traditional 60-40 stock bond portfolio has its limitations, and adding even a small allocation of alternatives to that, adding a can improve your risk adjusted returns. Second, REITs are the most accessible alternative asset for most investors. You can start with as little as, $80-90 because that's what's available out there for your ETFs. You get real estate exposure, regular dividend income, and liquidity. In 2026, REIT valuations, I told you, are really attractive. So this is a good time to look at REITs. Third, gold is your crisis insurance. So an allocation, total allocation between 5 to 20, nothing more than 15%, 10 to 15% should be in all of these assets combined, because you actually do a lot of good if you are invested in good equity and bond exposure. This should be only about 14 to 15% of your portfolio. And we spoke about gold. So uh, it protects your portfolio from market panics and currency devaluations and inflationary periods. Okay, and for crypto is optional, completely optional, but know that it exists. Okay, it should be kept really, really small if you're interested, 1 to 2%. Okay, through a regular platform or an ETF. There are a lot of ETFs in Bitcoins in the US market public space. Your action items this week: review your current portfolio, calculate what percentage is in alternatives, if at all you have any alternatives. If the answer is zero, consider adding a small REIT. Start from there. It is the most conservative starting point. Check if your account offers, it should also offer you whether you can buy gold ETFs and crypto ETFs and all that. open treasurydirect.gov account if you don't have it already. We spoke about it last week. In our next session, we'll probably talk about the private markets, what's available in private markets, what is out there. So that brings us to close the public markets beyond stocks and bonds. Thank you so much for your attention. I know some of the things are boring, but any questions, we can take it.
Thank you, Padma. We appreciate it. Thanks for your time and patience in kind of going over all this with us. I appreciate it. Today, we do not have any questions yet.
Okay.
So you explained it very well then.
All right. Because this is also a very different kind of a topic. So I thought there will be probably people will ask me about, what ETF to invest in if at all we are looking at all of these things. But maybe, they're still looking at stocks and bonds and all those things. Okay. So that's good.
It
Yes.
wasn't a dry topic at all, actually. It was very interesting.
Oh,
Yeah, I agree. I agree with that.
Yeah, because you covered so many different, topics within this topic, with REITs and
yeah.
gold and and crypto. I mean, these are all things that we talk about, consider very often. Many of us are so invested in as well with, like you say, with the cultural significance of gold. So
Yeah.
yes, there is. I mean, I thoroughly enjoyed today's topics just as much. Only, I'm so looking forward to all the
Yeah.
other
And
topics
also
just
we
as
kept
much.
in time, 45
Yeah,
minutes.
yeah,
That's important. Nobody fell
yeah,
asleep, I would imagine. So yeah,
yeah.
these
Thank
are
you.
the public markets that has all these things beyond your stocks and bonds. So a meaningful exposure to it makes sense, you know. So yeah, as usual, if you all have any questions, I'm always available.
Thank you, Padma.
Yeah.
All right. Thank you, Padma. Thank you, Suma. Oh yeah, you go ahead, Suma.
No, I think, yeah, today it was a very informative session. I think there is a question in regards to the video. We will be posting that maybe tomorrow or in the next couple days. That's what we do. I think if there is no other questions, we can end the session today a little early.
Okay.
Thank you.
Thank you, guys. Thank you. Thank you. Thank you.
Thanks, Padma. Good night,
Somebody is
everybody.
asking how many sessions happened. Can you?
Oh,
What
okay.
is?
Let me
What are they
read
saying?
that.
Can you please post all videos?
How many talks have been done so far since we
Padma,
did join?
so yeah, someone else had posted that question. It's all pinned. If you just follow one
No,
of
I
the
think,
pinned recordings,
yeah, I
they
think
should be able
Vidya,
to get to
Yeah,
the
yes.
playlist. Yeah.
if you go
So
to the channel, you would be able to see all the videos there.
yeah, so I think
Yeah.
the question here is to post the videos in Parul's one of the other WhatsApp groups, because we do post Padma's session details, the Zoom session there as well. So I can take that. I will do that.
Yeah, by far, seven. This is the seventh session. Yeah.
Okay, I'm stopping the
Yeah.
recording for today's session.
Thank you, guys.
Thank
I
you.
sent you all early because you all can